right. Well, thanks, Amy. Thanks very much. Welcome, everyone. A nice lineup of speakers this year. I remember having dinner a few years ago with Andrew Ross Sorkin, fascinating guy. Was down in Atlanta. I think I'm still on a board called Operation Hope, which helps people build credit scores to 700, which is a lot of fun. And then Sheila Bear takes me way back. Back in my banking days, we bought I think we were the second major acquisition of a failed bank after the '08 crisis. We bought a bank in Phoenix, and at the time it was a struggle for the FDIC. And kind of a quick fun story. It was a $3 billion deal. They couldn't get any bidders because everything was froze up in '08. But we had capital. I was with Mutual of Omaha Bank at the time, and I remember we bought this bank in Phoenix. They took all the assets, and we took $3 billion worth of deposits, and they sent us a $3 billion cash wire from the FDIC. And I remember getting a call from Sheila about 2 weeks later, and they said, "Did you get our money?" I said, "Yeah, your check cleared, Sheila. I appreciate that. And we'd like some of our money back." So at the time, it was about 10% of the FDIC fund, just that $3 billion alone. And they had a lot, as we all know, they had a lot of things in the windshield coming at them. And so we went through a cherry picking process with the portfolio, and it was a fascinating experience, and she was amazing to deal with. So I highly encourage you to take advantage of these speakers. Amy does a great job, and I'm pleased to be on the board, which actually has a really long-rooted history with the Federal Reserve Bank of Kansas City. Tom Honig sends his regards. I think he's in Washington, sent me a text because he was one of the instigators of the economic club here in Kansas City and still is involved. And my predecessor is here, Esther George, who actually a little bird told me, "Is it your birthday today, Esther?" Huh? Yeah, well, there you go. I would start happy birthday, but I'm not a good singer. But you look fabulous for 48, Esther. You probably should still be up here doing this. So, but thanks to the Economic Club for doing this. I'm so honored and proud to be a part of this Federal Reserve, and hopefully how we'll go through this afternoon together is kind of give you some kind of brief remarks, and I've got some prepared remarks. And then I'm happy to open it up to some question and answer if you've got something on your mind. Certainly the year started off quickly. David Campbell, we had lunch together. David was just put on our board of directors here, his first meeting. And what's interesting, he runs Evergy Energy. And I always think about the Federal Reserve as we're in the same business. He transmits power, and we transmit economic information. And we both hope we're never in the headlines, right? Because if you are, then something's not quite right. But it's really great to have David on the board and welcoming all of you today. So we've got two goals here this afternoon. One is to inform you about what's happening in the economy, and it'll be mostly macro, but there are a little bit of micro in some of my comments. And then kind of bring you up to date on the monetary policy side of what's going on with FOMC. I'm working on my third year here now at the Fed, starting to feel really comfortable with kind of my voice, and we've got this amazing group of people headed by Joe Gruber, the economists that really try to slice and dice all this amazing data and try to, and I go to Washington 8 times a year, and we speak our piece relative to what we believe is happening both in the regional economy that covers 7 states and the national economy. And it was a fascinating experience to have the vote last year, but really the vote is a bit of a nuance to the process. I mean, you've got 7 board of governors, 12 Reserve Bank presidents, form a group of 19. We get around a table every 6 weeks. And there's just a lot of very important collaboration and a lot of cross information about how we get to this decisioning that's really important. So that's job one. The second part of this is, and I really want to emphasize this, I know a lot of you have been here before. A lot of you have contacts with the Federal Reserve Bank here. If you don't, you should. So part of this process is for you to expose you to what's happening in the Fed here, but also to make sure you feel comfortable that you've got a connector to us, because this is a public service process. We are doing this work every day on your behalf. So there's lots of people in the room with little gold badges on. Some are board members, some are professionals with the Fed. But I always encourage people, if you don't feel like you have a connector, you should make these meetings happen where that connection happens. So I appreciate that. So also what I want to do is indulge me a little bit, because there's two important groups here in the room today that represent you. So this is a we the people process. The structure of the Fed purposely 112 years ago was to design these 12 regional banks to elect and pull in leaders that represent you individually, your communities, and your businesses. And so what I'd like to do is ask all present board members and any past board members of the Federal Reserve Bank of Kansas City, would you please stand and be recognized, if you would? Thank you. Come on, don't be shy. So some of you may know these folks, but they represent all 7 states, and so they're easy to find on the website, and make a connection with these folks. We just broke for our first year's board meeting here literally minutes ago, so we're off and running real fast, and it was a fantastic couple of days. The next I want to recognize, I am privileged and honored to work with a bunch of very committed people, very bright people every day that actually are doing the work of the Federal Reserve. You know, we can talk a lot about Fed independence, but I had a bit of an epiphany about Fed independence during the government shutdown. And the epiphany was, while the leaders in Washington were trying to figure out the shutdown, everybody at the Fed showed up and did their work. And that work entails moving $5 or $6 trillion worth of payments a day. It's making sure banks are safe and sound. It's making sure that even though there was a vacuum of research and data, we still had meetings with all of you to try to figure out, even through that vacuum, what's happening in the economy. So all of the professionals, executives, and officers, and former and retirees, because I know there's several of you here, please stand up and show us your faces here with the Federal Reserve, please. Yeah, see, once a Fed, always the Fed. I'm so happy you're here. So let's get started. Here again, these are important moments for me and for our team because we're getting around tables and we're inquiring what's going on in your world, and that all that information is being collected in the brains of the executive staff, and we're trying to really put it and weave it through the economic outlook that we create, which will start in earnest today and tomorrow I'll be in Washington in about a week and a half to go through the first FOMC meeting of the year. So, and it's really one of the benefits of this 12 Reserve Bank program. I mean, you've got 12 regional banks spread across the country, and it allows this interaction that we have on a regular basis, be it with boards, be it with professionals, or we have these amazing advisory councils. And that's what makes this work, and it's why it's important everything's not concentrated or centralized in Washington or New York. That's the beauty of the 12 Reserve Bank district structure. You've got the seven governors that represent and are in D.C., and then you've got these 12 reserve banks that really collaborate and hopefully come with the right decisions on your behalf as we try to keep this economy in an even state and moving forward. So now we're 2 weeks into 2026. While I'd like to keep my eyes on the road ahead, I keep glancing back a bit and really thinking about the developments of 2025, and because we're not quite done with synthesizing what happened in 25 as we move forward. So last year we introduced there was a fair amount of uncertainty in the economy, as we all know. Uncertainty that I don't think has totally been resolved, including the effect of higher tariffs on prices and output, as well as the potential outcomes of the tremendous surge in artificial intelligence investment on financial markets, productivity, and employment. But before diving into my outlook, I'd like to take a minute to look even further back. This year marks the 250th anniversary of the independence of our great nation, and we have a lot to celebrate. The United States has been a tremendous experiment in political representation, economic organization, and freedom. We have a lot to be proud of. We represent about a fifth of the global economy. Our innovation sector is the envy of the world, as is the productivity growth that underpins increases in our living standards. Closer to the Fed and its responsibilities, the creation of the Federal Reserve over 100 years ago established a system that could elastically supply liquidity when needed, reducing financial stress and panic and providing confidence. The resulting stability of our financial system helped to establish the U.S. dollar as the predominant global currency, lowering our trade financing costs relative to other countries. Part of what has made America so successful has been its decentralized federal system. Distributing authority encourages decision-making to take account of local conditions. The Federal Reserve, with 12 distinct regional banks working alongside the Board of Governors, embodies this national belief in decentralization. This model for managing monetary policy is uniquely American. I spend a lot of time here in Kansas City, in our branches in Denver, Oklahoma City, and Omaha, and throughout the district talking to business and community leaders about the economic conditions they face and the problems that they are solving. These conversations inform my views on the economy and provide the input I need to travel to Washington to participate in the Federal Open Market Committee meetings that set monetary policy. The decentralized Federal Reserve System is also important for what I call monetary operations. The reality is that the vast majority of the work done at the Kansas City Fed and carried out by the public servants that fill this building is not related to monetary policy, but rather to monetary operations. This includes maintaining the payments infrastructure that is the circulatory system of our $30 trillion economy. The payment system is essential to our economic health and must work consistently, safely, and securely. The staff in this building are also essential to the flow of money into and out of the U.S. Treasury. The Fed acts as the Treasury's banker, and staff here are integral to the daily transfer of billions of dollars from Social Security to disaster recovery payments. We also help ensure the safety and soundness of banking institutions throughout our 7-state region, bringing local knowledge and understanding to our interaction with district bankers. By enhancing confidence in the security of institutions of all sizes, our examiners help level the playing field and support the many smaller banks operating in rural communities that help define our region. The decentralized Fed also allows for differing views on the correct course of monetary policy. This is a strength of the system. Policy discussions are stronger when they incorporate a diversity of views. In October and December, the FOMC voted to lower the policy interest rate and ease the stance of monetary policy. The Fed sets policy to achieve its congressionally mandated goals of full employment and price stability. One way to interpret the recent rate cuts is that the committee had become a little more worried about the employment side of its mandate and a little less worried about the inflation side. My preference at both meetings, as reflected in my vote, was to leave the policy rate unchanged. My reasoning was based on three factors. First, inflation remains too high. Second, I believe that cutting rates could disproportionately harm the inflation side of our mandate without providing much benefit to the employment side. And third, I don't think that monetary policy is currently very restrictive. I will elaborate on these points in turn. First, let's talk about inflation. It is too high. Inflation is running about 3%, which is above the Fed's 2% objective. Last year's government shutdown disrupted the collection of official data, and although the flow of data has resumed, the effect of the shutdown on the quality of the data will likely persist through the first quarter and first part of this year. That said, what data we do have, including this week's CPI release for December, is consistent with an inflation rate that remains close to 3%. Over and above the official data, prices and inflation remain a top concern in my discussions with district contacts. These concerns show up in our regular survey of 10th district manufacturing firms. In December, these firms reported rising input prices and an expectation for further increases in the months ahead. While firms report moderating wage pressure, I have heard quite a bit about rising healthcare premiums. Inflationary pressures could build further if firms raise selling prices to offset these higher costs. To this point, a national survey of small businesses showed a sharp increase in the percentage of firms reporting higher average selling prices at the end of the year, and the index increasing to a post-pandemic high. There are some encouraging signs, however, on inflation. Housing costs and rents are moderating. While I'm hopeful that price pressures will ease, I am reluctant to step back until I see more convincing signs that overall inflation is headed in the right direction. Both non-energy goods and non-housing services inflation, categories that together account for roughly 80% of consumer spending, remain above levels that have historically been consistent with the Fed's 2% inflation target. Price increases across goods are widespread, including food prices, which are especially salient for households. Along with food, rising electricity prices are receiving a good deal of attention in many communities, and these costs are likely to continue to climb. This was noted during the energy conference we hosted towards the end of last year with the Dallas Fed, where it was highlighted that the power sector is struggling to keep up as higher demand stresses an aging infrastructure. Meanwhile, significant new capacity is likely years away. The Fed's job, as I see it, is to set interest rates to maintain the balance between economy-wide supply and demand. And the best indicator of that economy-wide balance is the overall inflation rate. With inflation too high, prices are sending us a signal that demand growth is outpacing supply growth. Inflation has been above the Fed's 2% objective for over 4 years now. I don't think we have room to be complacent. History has shown us that persistent inflation can shift the psychology around price setting. With inflation, and it can become ingrained. Were that to occur, re-anchoring inflation at 2% would be more difficult and costly. It is unlikely in that situation that we will still be talking about soft landings. As I have said before, I take small comfort in most measures of inflation expectations having not moved up. I view inflation expectations not as an input into the Fed's decisions, but as an outcome of the policy decisions that the Fed makes. Looking back over the past few decades, one of the greatest economic policy successes for the Fed, for the country, and perhaps the world, has been the decline in worries about inflation. It is not just that the level of inflation had decreased, but also households and businesses perceived risk that higher inflation could happen again. The declining risk of inflation for most of the past 3 decades has had real benefits, allowing greater certainty and better planning. My concern is that we risk moving away from a world where, to quote former Chair Greenspan, inflation is so low and stable over time that it does not materially enter into the decisions of households and firms. In 2019, only 1% of small businesses reported inflation as their most important problem. In December, 12% of small businesses reported inflation as their number one problem. We should never underestimate how much people hate inflation, and for good reason. Inflation is an economic thief. Holding all else equal, a 1 percentage point increase in inflation lowers the purchasing power of U.S. household income by close to $300 billion. Though I believe our credibility on inflation remains intact, I don't think we can be complacent, and the costs of losing that credibility are very high. So let's talk a little bit about the labor market, which has got a lot of interest here in the last few months. The second factor informing my views on monetary policy and my preference for keeping interest rates unchanged really does revolve a little bit around the labor market. I believe that there is a risk that lowering rates could do more harm to the inflation side of our mandate than benefit on the employment side. The labor market has clearly cooled in recent months. The pace of job creation has fallen off sharply, and the unemployment rate has ticked up. Other indicators are more mixed. The number of new claims for unemployment insurance, a sign of layoffs, remains near record lows. And a large part of the step down in job growth reflects the departure of federal workers from government service. A useful summary of the sometimes conflicting data is the Kansas City's Fed's Labor Market Conditions Indicator, released monthly and accessible on the bank's website. I really encourage you to check this out. This measure, which combines 24 different data series into a single indicator of labor market health, has been cooling but remains a touch above its historical average. Overall, the data suggests a low fire, low hire labor market. A possible explanation is that this is just the flip side of the labor market we saw coming out of the pandemic. An extremely tight labor market in 2022 and 2023 led to an outbreak of labor hoarding as firms held on to as many workers as they could, worried that they would not be able to hire to replace turnover. Now that the labor market has cooled, firms are finding that they are well stocked with workers and able to accommodate attrition without having to hire. This certainly aligns with what we have been hearing from regional contacts, that headcount reductions are occurring primarily through attrition rather than layoffs. In addition to this dynamic, there are large-scale structural changes that are also affecting the labor markets. First, the United States is at a demographic inflection point, which, in combination with the dramatic decrease in immigration, has led to a deceleration in the growth of the workforce. A smaller workforce leads to both fewer new jobs and fewer unemployed people looking for jobs. Estimates by my staff suggest that an aging population and declining immigration could lower the break-even level of employment growth, that is, the pace of job creation needed to keep the unemployment rate flat, to somewhere in the vicinity of about 50,000 jobs per month. On top of the demographic changes, we are also hearing quite a bit about AI and the potential impact on hiring. Almost every firm I have talked to has expressed interest in utilizing AI and is weighing any increase in headcount against an AI alternative. The structural undercurrents affecting the labor market suggest that monetary policy might not be the right tool to address the cooling labor market. Monetary policy is best suited to address cyclical downturns in the labor market coming from a shortfall in demand. As such, I do not think further cuts in the interest rates will do much to patch over any cracks in the labor market. Stresses that more likely than not arise from structural changes in technology and immigration policy. However, I worry that cuts could have a longer lasting effect on inflation as our commitment to our 2% objective increasingly comes into question. Which brings me to the third factor shaping my view on interest rates, which is that the current stance of policy does not seem very restrictive to growth or economic activity. The economy grew by 4.3% in the third quarter of 2025, the fastest pace in 2 years and far above recent historical trends. Consumption growth has been strong, as has investment spending, especially for IT-related capital goods. Looking ahead, changes in tax policy and deregulation are likely to spur additional business investment and support consumer spending, further boosting demand in the new year. Discussion of the restrictiveness of policy is often wrapped up in the academic conversation around what is referred to as the neutral rate, or R-star. Simply put, the neutral rate is the theoretical rate at which monetary policy would neither restrict nor boost growth. Before the pandemic, there was a widespread understanding that the neutral rate had declined. One way to see this is when the interest rate was set to zero for an extended period of time, economic growth remained lackluster and inflation did not pick up. Even at zero, interest rates were not stimulating much activity. The low neutral rate during this time was attributed by many to a high desire of savers to save and a low desire by investors to invest. Some call this a savings glut, while others preferred to call it an investment drought. Regardless, the imbalance between the desired savings and desired investment put downward pressure on equilibrium interest rates and hindered the ability of monetary policy to stimulate growth. Where are we now in regard to the neutral interest rate? Long-term interest rates are quite a bit higher now than they were in the decade before the pandemic. The yield on the 10-year Treasury is about 4.2% compared to an average of 2.4% throughout the 2010s. All else being equal, higher interest rates might be expected to push down investment and push up savings, but that's not what we're seeing. Last year, investment ran about 21.5% of GDP, about 1 percentage point higher than in the 2010s. In contrast, the economy-wide savings rate has fallen by almost 2 percentage points over the same period. Even though interest rates are higher than in the 2010s, the economy is saving less and investing more. This suggests the savings glut or investment drought, whichever you prefer, that was weighing on interest rates prior to the pandemic has diminished. As such, the data suggests to me that the neutral rate, interest rate in the economy has moved up, and that the current stance of policy, which could have been restrictive before the pandemic, is no longer very restrictive now. With inflation pressures still evident, my preference would be to keep monetary policy mostly restrictive. And I will judge the restrictiveness of monetary policy by how the economy evolves, both in the data and based on what I'm hearing from you and other contacts. Right now, I see an economy that is showing momentum and inflation that is too hot. And while the labor market has cooled, some cooling is likely necessary to keep the inflation outlook from worsening. I see little reason at this point to further lower the policy rate, though of course I will be watching the data closely for signs that growth is losing momentum or that the labor market is weakening more substantially. So that kind of gives you a framework of kind of where we have come through 2025. Just make a couple editorial comments that the closer you get to our mandate, that's 2% inflation and full employment, the harder the decisioning becomes. When inflation's raging at 7 or 8%, you use your blunt force instruments to try to pound it down. And now as we're trying to get us closer to that, what we call soft landing, which is getting an inflation rate to 2% and with full employment without breaking anything, going into recession primarily, it just gets to be a little more difficult to do, and it's a little bit more surgical. But with that, I would love to entertain any questions you have as we move into this new year. Perfect time for the conversation. And I think we've got a couple of microphones that we're going to we got both sides here. So let the fun begin. Who's got the first question here today? So go ahead.
Comment. We want to welcome the international media who's listening in right now. They are joining us for this event. So if you would kindly wait until the microphone gets to you, that'd be great. That way they can hear you too. Great.
Sounds good. Yeah, please, sir.
Yeah, Tim Petty with U.S. Bank. Appreciate all that you do for us here in Kansas City and your team. It's really great to have an organization like yours in our community. So question is about kind of in line with one of the speakers that you have, because he's not the only one that has the opinion of a great economic downturn similar to the crisis we spent, almost 100 years ago. And so with the rise in the debt, the transfer payments, and everybody kicking the can down the road, have we went past the part where we really have any ability to affect it? And if we don't, how likely is the likelihood of that kind of a catastrophe that happens, and how long does it last if it does?
Did you say catastrophe? Yeah. Well, look, I guess I'd give a couple comments to that. One is the debt's interesting. I mean, the one thing that you realize that, as I mentioned in the comments, is the neutral rate, in my opinion, has increased over time. That has a lot of fathers. I mean, you could make arguments that inside especially the long-term rates, that there's a term premium that's been built into that let's say the 10-year that didn't exist, and maybe it's because of the debt structure. I mean, you've got almost $40 trillion of U.S. debt, and you've got, I think, total global public debt's about $120 trillion. So I think the nature of the long end of the curve is something that I'm sure is influenced by the supply and demand of private and public credit. It's not something that is in our purview. I mean, what we try to focus on, one is the mandate around the 2% inflation number and the full employment number, and that short rate I think influences the inflation number maybe even more than the employment number at this stage. But I think the markets seem to be reacting and acting well. They seem to be there seems to be enough reserve liquidity in the system, and I think we just got to focus on what we can do, and a lot of that is just keeping our eye on the mandated policy side of things and making sure that reserves and liquidity are ample to run this $30 trillion economy. So what you hope and believe is that if you do that, you hopefully will avoid any crisis scenario. But that's the monetary policy side. Then you've got a lot of other people involved on the fiscal policy side that really probably could address the things that you're talking about much more actively than the Fed. So, yeah, please, Tom. right behind you there.
What level of unemployment would cause you to change your vote?
Oh, wow. Okay. So, everybody has an opinion, right, of what full employment is. What's interesting is, back when I was going into school, 6% was full employment, the unemployment rate. But what's fascinating to me is if you deconstruct the nature of the unemployment rate, we all know that about somewhere north of 3% is always in flux, right? People are moving constantly. You got, I don't know, 160, 170 million people in the country that are in the workforce. So what's interesting to me over the last 2.5 years is when the unemployment rate was down in the mid threes, everybody was complaining about, one, not being able to find people. Two, there's a lot of inflation there's a lot of wage pressure inside that. So there is a range bound number. I don't know exactly what that is, but I would say somewhere between 3.5 and 4.5 seems pretty comfortable to me. The question becomes, and a lot of my speeches and a lot of my research around my recent votes is that we have more of a structural issue in the labor force than we do cyclical. So if in fact growth dropped precipitously and that was creating a cyclical effect to the labor force, then I think you would start to have a pretty good argument that maybe you'd move the policy rate down to try to accommodate the cyclical side. But right now it's structural. I mean, we have 4 million people a year, probably through 2028, that look like me, that are in baby boomer age, that are leaving the workforce. That's about 300,000 people a month. Then you've got probably another 1 million to 2 million out of the workforce from the change in immigration policy. So you truly have a structural issue going. In fact, there's in the last Jackson Hole, we had a couple of really great papers on demographic changes. So I think in the next 10 years, the U.S. goes actually negative on net workforce growth because our kids just aren't having as many children as our grandparents did. That's going to be an interesting dynamic. And then you also have globally, the numbers are even worse. So in some respects, I think we almost are going to have technologies like AI to actually supplement some of that going into the future. But I would say that if in fact unemployment rates rise and you believe it's a cyclical nature in the economy, then I think you start to have maybe a little bit different opinion of where the monetary policy rate should be. So. Oh, please, up here. Yep.
Hi, Jack Montgomery, BMO Bank. My question is somewhat of a two-parter. So the Bureau of Labor Statistics, obviously in the past years, had several restatements. I know that's a significant portion of what you guys use to determine where you guys feel the Fed fund rate will be. So my two-part question is, one, given the restatements, do you still feel confident with the BLS's reporting? And then two, given the low response rate, do you feel that the BLS can continue to report on labor in an accurate fashion with their kind of current metrics?
Yeah, those are really great questions. So a couple things on the first question. So clearly we use BLS, and historically I've used BLS as kind of a part of our analytics. I mentioned our labor market conditions index that we issue at the Kansas City Fed. That's got what I kind of prefer is to find elements in a basket and try to see if you can get a little bit of the top and low end noise, the adjustments, whatever they are. Try to get that out of your analytics. Even though the BLS numbers are a function of that, there's a lot of other things that go into an index like LCMI that I actually rely on even more than just the BLS numbers. Now, some of those numbers are not unlike the unemployment rate, are pretty standard use for economists to try to figure out what analytics. You're always going to look at the level. Do you like the level? Is it above or below, and what is the trend doing? But I think I think once we collaborate with the people in our district, things, environments like this, and then roundtables that we do a lot of. We have advisory councils. You kind of pull in that real time, and then you try to mix it up with things like the BLS data, and hopefully you're getting the kind of data that from a trend standpoint that you're going to like as a policymaker. Now, the second part of your question's even more interesting, and I'm actually hopeful. I think there's a lot more discussion about how government agencies that provide data to the marketplace are trying to innovate and try to get more real time about what they do. I actually think a lot of the artificial intelligence platforms that are emerging are going to be a big updraft for a lot of the data collection organizations in the country, including the government agencies. So the frustrating thing for me, because I'm a hybrid Fed president, I came up from the outside. I didn't grow up in the Fed, but as a business owner, you always wanted to try to project yourself because you're trying to risk manage the future, right? And I think the lag of information when I came in was always the more frustrating thing. It's like, man, how do we pull this stuff into much more real time? And I'm hopeful that BLS and other agencies are actually taking a kind of a different look. One, they're frustrated as anybody about the adjustments. Nobody likes the adjustments. But to use things like paper surveys or emails, I mean, that's starting to get a little bit like the horse and buggy, right? And so pulling all that information and trying to be innovative about it, I think I'm seeing more of that happening within these organizations that issue data. So I think we're gonna look back in a couple of years and say, wow, that was some really good change. So. Very good.
Unfortunately,
Yep.
That's all the time we have. I believe.
1:30 already? Wow.
1:30.
Gosh, I can't believe I didn't get a couple questions about Chair Powell. Anyway, let me end by this. This whole conversation of Fed independence, and I've said this many times, it's much more that you have an understanding about what Fed independence means to you. I could be up here for hours talking about how important the Fed is and how integrated it is into the greatest economy of the world. Much more important that you know. So if you need information to empower you about what Fed independence mean or what an independent central bank is, we're easy to find. But I think I believe in my DNA that an independent central bank is very important to the nature of managing this amazing economy. So, but if you need resource, if you'd like more specifics, please reach out. Like I said, this is your Fed. I'm honored to serve in it, and I'm glad you were here this day to talk about the new year we're into. So, Amy, thank you very much to you and the board, and I hope you all have a great afternoon. Thank you.
President Schmid, thank you. We'll see you next time. Thank you very much.